Today, folks, I told you I was going heavy in this market. There is so much fear on the backdrop of what have been incredible earnings that will only be shrouded by what inflationary data comes out mid-May, even though the Federal Reserve kind of just saved the market yesterday. Now, we're going to talk about this convoluted mess that we're currently living in, how I feel about it moving forward as we take a look at Apple's earnings that haven't even dropped yet. They're going to drop in about 15-20 minutes while I'm recording this, so you'll kind of almost get like my real-time reaction. And if that is a conversation you'd appreciate, hit that like button because the markets are up about 1.8%. I told you I'm not going to go cash like everybody else. Like, I see this as a dip in the market. It's a potential opportunity to pick up some shares, and I bought fairly aggressively. And if we take a look at the secular, stocks, we're going to take a look at consumer discretionary, your staples, your banks, obviously your tech companies here to see how earnings have affected them, because honestly, you have to zoom out on a year to date, I think, to get a clerical image of why some of these stocks might be correcting. Now, in the big tech companies, when you're talking about Amazon, Google, Meta, Microsoft, Apple has been the only lackluster performer. And if Tesla is any example of what could happen, even if Apple posts bad earnings, they might go up because they've been pretty suppressed this year. But if you zoom in on the 1 month, I think it gives a more clerical view that, Meta corrected pretty dramatically, but that's because it's been the best performer this year. Even with that massive correction they experienced, they are still outperforming all the other big tech companies, right? And we're going to talk about the chip makers here in a moment. I know I'm not including that on this list, so you got to be a little careful because we have seen some corrections in Microsoft and Google pulling back a bit, but you got to remember on the year to date, these things are doing very, very well. Now, one of my big concerns is that the end consumer might not be as strong as we think they are. I mean, we've been debating this constantly because the Federal Reserve has said there's still a really strong jobs market, and they're not going to cut interest rates unless either inflation gets down to their target rates or the jobs market starts to get hindered. But when McDonald's, the CEO, comes out and says, hey, like, the consumer is being very particular about the dollar they're spending at one of the cheapest places you can go and eat, I think that is more of an example of lower middle class Americans, right? And we're seeing these stocks get hammered this year. I mean, your Starbucks just got wiped out, which I think is a huge exemplifier to people not wanting to spend big dollars on coffee. But even McDonald's to be trading down in Dutch Bros, that shows me a bit of concern. But on the backdrop of the banks, when you had the CEO Jamie Dimon from JP Morgan saying that they're still a bit concerned about where the future is going, but today it's still relatively strong, and the banks have been exceptional this year. I mean, we've gotten great growth that is almost comparable to the tech companies this year. So congrats to those that have been picking up the dips on the banks. Wells Fargo up 21%, Citi 15%, and JP Morgan up 11 percentage points. When you look at like Procter and Gamble and some of these consumer staples, this is where things get interesting to me because, we've been talking about debates with Loblaws and some of these Canadian counterpart companies that have been being boycotted right now because of how greedy they've been on price hikes and just nefarious things to continue to make money. This sector has been also quite strong. I mean, Procter & Gamble is doing exceptionally well this year, up 10%. Pepsi actually posted some fairly reasonable numbers. Costco's been doing great here. Like, this is just showing you these sectors, right? And these are the sectors that I think affect most people. And the fact that they've been this strong, again, doesn't mean they're going to be that strong moving forward. Again, there's nothing saying that the straw that broke the camel's back hasn't actually happened yet. And again, we'll see what happens getting into interest rate cuts. They should be cutting interest rates now. Talk about that in a second here. If you take a look at the chip companies, guys, I've been telling you, and I told you, I think we're going to go through a correctional period here. These things just got way out of control with the growth rates, and I think we're going to start seeing that nominalize, and we have been, right? I mean, year to date, NVIDIA is up 78%. Most of these chip companies have been crushing it. We recently saw some, AMD. We've recently seen some earnings, the things like Intel or some news anyways, and you zoom in the 1 month, and we're starting to see these correct pretty dramatically. But again, you have to imagine they're correcting because of the massive run-up we've had this year with the exception of Intel, right? But again, I wouldn't be surprised if this starts to nominalize a bit, as you can't have these kind of growth rates in perpetuity forever. So NVIDIA is going to be one interesting stock to watch on its earnings. And another thing that's been hindering a lot of these companies, Starbucks, all of them on a global scale, is something that Amazon posted here, which basically said that their anticipated unfavorable impact of approximately 60 basis points from the foreign exchange rates. And it's like one of the top reasons they think that growth is going to be nominal at 7 to 11%. For their second quarter of 2024 guidance. And I keep telling you guys, you need to pay attention to this, right? The US dollar, as much as people think, the US currency is garbage, Go anywhere in the world with US dollars right now, and the USD has been stronger than it has been since basically you'd have to go back to about 2002, the dot-com era, to see the US dollar as strong as it has been today, which is insane, right? I mean, you can go on the DXY, take a look at the US dollar, and you can compare it to your own currency, right? Like in Canada right now, one US dollar is the equivalent of about almost $1.37 CAD. I mean, that's insane. That's a 37% difference. And I mean, if you took all your Canadian dollars, the best time to dump them and exchange them was, in 2021, before the interest rate cycle started to really affect the USD. There's a 13% exchange difference. You'd have made a 13% extra return just converting currency in 2021, right before they started to do the interest rate cycle, right? So there's still some concerns. Interest rates are the real thing that are potentially going to break the camel's back. I mean, we can't have super high interest rates forever. I think it's really damaging to the economy. And I think the only reason it hasn't fully, put us into a recession is because the jobs market is so damn strong, which is great. It's kind of the tale of two stories here, right? The jobs market versus people struggling to make payments and debt payments, right? And the U.S. Federal Reserve came out yesterday and said they highly doubt they're going to do any interest raised, any more interest raises in this cycle. The market got really bullish off the fact that even though we might not be cutting interest rates yet, it's highly unlikely we're going to raise them. And he said the jobs market remains strong. However, if jobs get weak, if the economy starts to show signs of struggling, they will cut rates. But what they're waiting for right now is inflation to calm down, and it's not going to, guys. I feel like we're going to struggle to get to a 2 percentage point of inflation rates, because we have gas and housing problems. Gas problems, like for the midst of April, like gas was peaking, right? Like through March, one of the primary inflationary pressures was oil and housing. Housing and pressures are caused by interest rates, and oil is caused by these geopolitical events. But we can see through March, right? Like it kept going up. And then through the midst of April, gas prices peaked. So we're going to see this hit the inflation report for the month of April when we get I'm pretty sure when we get the data on May 15th. So it's something to look out for, that it's probably not going to be the best inflation report, right? But hopefully, we see oil continue to cool off like it is now. And through May, come summer, that's when we can start getting a more bullish Fed on interest rate cuts. At least that's what I'm hoping, but we're really gambling because it really purely comes down to oil and housing. And housing is not going to be solved until they start cutting interest rates. Because interest, again, you raise the interest rate, mortgages cost more. The landlord's going to raise the rent on the tenant to make the payments, blah, blah, blah. That takes so long to bake into the economy as mortgage renewals come up over time. So that's just kind of where we sit with that, right? So let's just take a look here, because we're getting Apple's earnings right now, and I really want to see how this does for the rest of the market. So here's my real reaction, because they haven't been posted yet, and I'm going to add it right now. All right, folks, here we go. We just got the numbers. Let's get into this together. With first and foremost, the company has posted quarterly revenue of $90.8 billion, down 4%. No surprise. Diluted earnings per share, $1.53. This is not the best thing to see. The company's flat. They're just not growing at all for like the last year. And something tells me, I think analysts had lower expectations, didn't they? I mean, I wouldn't be surprised if they beat analysts. But basically today, Apple is reporting the revenue, with Tim Cook basically saying that during the quarter, we were thrilled to launch Apple Vision Pro and to show the world the potential of spatial computing. Apple Vision was a complete flop. Sales were just garbage. They said they're not going to be releasing a new version of it or something. I mean, I'm surprised. They're going to have to backtrack that on the earnings call. But we're also looking forward to an exciting product announcement next week and an incredible worldwide developers conference next month. So next week is going to be pretty exciting for the company. That could be driving some growth here. Thanks to the very high level of customer satisfaction and loyalty, our installed base of devices has reached a new all-time high across all products and geographic segments. Not sure what they're pumping about here. Anyway, let's just break the numbers down. Let's just kind of get into it and take a look at the balance sheet. Let me zoom my head out and make these numbers nice and large so we can see them. Here's the numbers, right? So total product sales down pretty dramatically from almost 74 billion to 66.8. That sucks. Services driving the stock. Obviously, like Microsoft, they want to move more towards subscription-based services, cloud computing, Apple, their video service, streaming service, all that stuff. So that's what's been really kind of a savior to the company, making up for some of the lackluster product sales. Because if it was just for products, Apple would be tanking miserably. They've been increasing gross margin. That's good. Cutting costs. We've been seeing that. If we take a look at segments, let's just see by demographic here. So Americans have been flat and down slightly for sales. Europe is actually up slightly. Greater China area down. Japan down. The rest of Asia Pacific down. So yeah, it's been a tough market environment for Apple here. iPhone sales are down dramatically from 51 billion to 45, 46 billion. Macs are actually increasing slightly in sales, so that's good. Something nice to see. But keep in mind, from this time last year, I think Macs were getting just hammered. Obviously, iPads are not looking great. Wearables, I'm surprised they're down. Wearables have been a huge thing for them. And again, services are the only thing crushing it for them. And it sucks that they're not really including the Vision Pro in these numbers. I mean, that would have been the best thing to see. Let's just take a look, because something tells me they're probably paying down a lot of debt. So we got total current assets have actually been decreasing, and the only reason I can presume these went from 143 to 128 is because it's going toward debt. Total assets, that's current assets. Total assets, yeah, still decreasing from 352 to 337 billion. Whereas if we take a look at total liabilities, have also come down pretty dramatically. So do keep that in mind. Total liabilities are down to 263 billion from 290. So like Amazon and many other companies, Amazon's been issuing shares to pay down debt. Apple probably using cash and other means to continue to pay down debt. Everyone's looking to kind of strengthen their balance sheets in this tougher market environment. Let's see how the stocks respond. Yeah, it's up 4%. I mean, look at this after hours. Stocks crushing it right now. No surprise. It's up over over 180 bucks a share. I'm not sure why. Obviously, yeah. So Apple, they beat their analyst expectations of $1.50, came in at $1.53. The revenues 90.3 billion was expected. They had 90.75. When analysts lower the expectations so much, it's no surprise that they beat. And obviously, they buy back additional 110 billion of shares to boost the quarterly dividend. So, I mean, yeah, wow, share buybacks even. Again, it's kind of like the General Electric of today. That's what Apple's kind of become here. I don't think they're as exciting as they once were, but you can't argue that iPhones, MacBooks, these are incredible products that aren't going anywhere anytime soon. And hey, just like Tesla, you can only beat the stock up so much, and now it's up 7% in after hours. You can only do so much, before investors kind of get excited here, right? So congrats to anybody that picked the dip up. This only concludes the S&P 500 is going to continue to do well, and it's going to help revitalize the tech sector a bit here. This is why I go aggressive when everyone's getting bearish, because it's worked to my favor 9 out of 10 times so far. Every time the market dipped, we went heavy. In October of 2023 there, we've been going heavy through most of this secular, terrible market environment, and it's worked every time. So I'd love to know what you're doing, what you're buying in that comment section below.